Hi, my name's Kurt. I'm a value investor, and today we're going to be looking at Under Armour stock. I got this request to do Under Armour because I did Nike a few weeks ago, and so those are rival companies. And so, what's the value of Under Armour stock, and is it comparable? Should we pick Under Armour or Nike if we want to invest? If you want to watch the video I did on the stock analysis of Nike, then you can click here. I'll put a card right here. Watch that one as well. But here's Under Armour. And today what I'm going to do is, instead of doing my normal presentation, I'm going to be doing a live reaction, a live valuation. So I'm going to pull up the spreadsheet that I've developed that I personally use to enter all the financial data of a company. And it does the discounted cash flow analysis function for me. And it'll give us some results, some things to look at, and we'll discuss. So let's jump into the spreadsheet. Okay, so as you can see, this spreadsheet is completely blank. I can flip through the different tabs here and you can see nothing's filled in. So what I'm going to do is I'm going to paste this information, this data in live from Macro Trends, which is a site I use where I can copy rows of data and paste them straight into the spreadsheet. We will enter in our assumptions and the spreadsheet will calculate the free cash flow in projection and then do the discount rate for us so that we can just sit back and analyze it. So we entered in the ticker here, and okay, we can see, by the way, we're using UAA, which is I think the Class A shares. There's also Class C shares, which are under the ticker symbol UA, so don't get too confused. But market cap 3.3 billion, and it's a price of $7.68 right now per share. So let's go to the free cash flow tab where the important stuff is going to be. These links again that I'm clicking on are Macro Trends, and it makes it really easy for me. So bear with me as I paste all this information in. Now, automatically, we're going to have an issue here because you're going to see in a second, Under Armour does not have positive free cash flow. I'll say again, Under Armour does not have positive free cash flow. There's only a couple times that it's had positive free cash flow in the last 10 years. That's not good. That makes it really difficult because we like to project future free cash flow and then discount that. And if the company doesn't have positive free cash flow, unless it has a really big balance sheet, it's going to be really tough to evaluate. But let's just sit back for a minute. Let's just paste all the data in, and then we can come back and make a free cash flow in the future, assumptions about that may be different than the past, and we can look at their earnings and look at their revenue trends and see what we think. So let's keep going. I'm going to paste in the return on invested capital data, which actually is fairly good, I'd like to say. I drew that black line where we like companies to be above, so that's that 10% mark, and it looks like recently they are hovering around that amount, although in the past, on paper, they've had some weird, it looks like the accounting hasn't been super straightforward, so let's just skip past that. They don't pay a dividend currently. They did it one time, but I'm going to ignore their dividend. Let's look at their profit. Now, this is going to be really important since their free cash flow is negative. And when they have positive profit but negative free cash flow, that means to me that it's a really capital intensive business. It requires a lot of redeployment, taking from the profits and spending it on capital expenditures to keep the business running. That's not necessarily good. So, but look at their profit. It's sprung up since COVID. It's been really positive, like $400 million in the trailing 12-month average. Okay. Let's take a look at their revenue trend. Let's go ahead and put in their balance sheet. $656 million in cash on hand. In inventory, they have 1.1 billion or so. Current assets, 2872. Property, plant, and equipment is $688 million. Intangibles they have listed at 483, and I think that intangibles is really important for this type of business, but it's actually not that big of their total assets at 4.7 billion. That's pretty good. All right, 1283 is their current liabilities. Long-term liabilities is 1373. hey, that's not that bad. I mean, the cash on hand is really covering their current liabilities. I mean, it's not covering them fully, but it's a decent share of their liabilities. So I feel pretty good, especially that the receivables is $800 million they have written down for their receivables. So total liabilities is 2.6 or so billion dollars, which means after our adjustments, they have a per share net quality assets of $3, which is substantial because they're trading at $7.68. And keep in mind that this is a $3.3 billion market cap. But yeah, $7.68, and their balance sheet makes up, according to what we're saying, $3 of that. So they only need to make up another, so as long as their free cash flow makes up some of the other. But what we don't see is that the balance sheet is fully covering their justified valuation. And we already know that the free cash flow is negative. So things aren't looking good for Under Armour so far. Usually when I see a company that doesn't have positive free cash flow and definitely has negative sustained free cash flow, I automatically skip and move to the next company. So I'm sorry, Under Armour fans, but when I'm looking at Nike and looking at Under Armour, Nike has positive free cash flow, long historic trend of positive free cash flow. Under Armour doesn't. So just right off of that information alone, we're kind of saying that Under Armour is uninvestable, so to speak. But let's just use some assumptions here. What I need to do is I need to type in here my base year free cash flow. Now, obviously, this is negative. It's negative. The average over the last couple of years is like negative $180 million a year. But let's say that we can recover and get back in the positive. And let's say if we follow a trend line that brings us somewhere around $100 million a year in the current year. I know that's optimistic, especially since that's not where we are at all. But then that allows us to put some growth rates on a positive free cash flow to say, hey, there's going to be positive free cash flow in the future. And what kind of a growth rate should I use? Well, when we look at earnings, it's grown 15% per year over the last 10 years on average. And when we look at revenue, it's actually the same. So, okay, so 14 is a little steep. Maybe we'll say something like they'll grow at 10% per year for the next 5 years. And then they'll grow at 6%, let's say, over the next 15 years. And then the perpetual growth rate, because Under Armour is such a big brand, I feel like it will be growing. It will be around in the future. It won't be growing fast, maybe, but I'm going to put something like 2%. I think I did 3% perpetual growth rate for Nike, and I think that that's justified to put Under Armour 1% lower. So these are our growth rate assumptions into the future. Now, they are also buying back shares in the short term, but in the long term, they've been increasing their shares outstanding. I have that graph here. Yeah, I'm gonna say positive 1% per year in the next 5, and I'm gonna say 0.5% in perpetual. That's a little bit. That's just following the long-term trend that I see here. Okay, so now that we've put all those assumptions in, our discounted free cash flow analysis is going to be on the general info tab. And what do we see here? We have the non-margin of safety, the raw data here, and then I have the margin of safety information here. I'm going to switch the margin of safety discount to the traditional 70%. So it's going to take all the numbers and multiply them by 70% or divide by 1.3. And we're going to see here that we don't have a ratio of the value and price. Even at a 10% discount rate, they're not equaling because that's only $6 a share, and it's currently at almost $8 a share. So, but if we take the 5% discount rate, we could justify $11 a share. So it's somewhere in between $5 and $10 a share. So I'm going to go ahead and say that just based on that margin of safety, with all the assumptions we put in, and those are optimistic assumptions because of that free cash flow that we had to flip from negative to positive and assume it's going to grow from there. But all of these rosy assumptions, I'm going to say the stock is still around an 8% or 7%. Maybe we'll be conservative and say 7% expected return. And if we want that 15% return with a given margin of safety that we feel comfortable with of 70%, $4.20. So the price really isn't justified, which is pretty crazy that you think that the valuation, the price got all the way up to $52 a share in the past. And now it's come all the way back down, but I still don't think it's down low enough. I'd be waiting for about $4 a share to buy into Under Armour, if I'm being completely honest. And let's take a look at the pillars also, which are just showing up here. 5 out of 8 isn't terrible, and 15 out of 21 isn't bad either. So because they don't pay a dividend, they're good on that. The return on invested capital was a check mark, but it was a little fishy. They have a PE ratio of 8, which is good. Free cash flow ratios there. Not super consistent profit, but they do have consistent growing revenue, which is good. So yeah, that's not like flashing off the page for me. I think I would end up giving this around a 5 out of 10 investment, or even lower, maybe a 4 out of 10, just because it has some good fundamentals here, like not great, not fantastic, but overall like okay to good. It's a great brand, and I mean, we could foresee above 5% return, and so that's not great. Maybe I'd say 7% return expected. So that's not great, but you know, I guess it's not terrible. The biggest thing about this company is that it doesn't have positive free cash flow. So when we're doing valuations, we love to see free cash flow. Otherwise, we're just hoping and praying that the cash flow goes positive at some point. I'm just now realizing that my trend line here is a little wacky, so let's go ahead and switch that to a better function. And you can see the R squared is not that great. Like, there's not a good fit of the price action to the trend line, which means the price of this company sways a lot in big, you know, in major ways that it's not very predictable upward trend. Obviously, it spiked way up, it's come way down since then, and it is where it is now, and where it is now is like where it was, you know, 10, 12 years ago. I mean, that is not very good. You don't want to have that long of a period with negative even returns. So Under Armour, I'm unimpressed. But if you own Under Armour, go ahead and comment down below. Why do you think that this is a great company to own? And if you're a fan of Under Armour, hopefully it does better for you. So with that, I hope you enjoyed this style. I hope you enjoyed this style. I hope you liked this live filling in the data and seeing my reaction live about a company and evaluation. I truthfully didn't do this analysis before sitting down here, so you got to see my reaction live. And again, this came from a comment that someone left in another one of my videos. So if you want to see another stock analysis valuation, go ahead and comment down below. And with that, thank you all for joining me. If this video provided you value, make sure you hit the like button, subscribe, and don't forget the most important thing, the ring, 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 so you can stay up to date and get those notifications. Best of luck investing, and take care. I'll see you next time.